I haven't shaven today and my hair looks a little weirder than normal, but it kind of matches the unpredictable nature right now of what is going on in the stock market. I'm going to show you why things are so confusing going into earnings season. I'm going to talk about where I would park capital right now to sleep a lot easier at night and collect some cash flow, because we don't know whether we coming or going. And if that is a conversation you can appreciate, because I can't sell you anything here, I just want to talk about it. Hit that like button, folks, because let's talk about, first and foremost, the Fed wants to raise a half point on the interest rate here, and people were shocked by this, like, oh my god, they're gonna jump the rate higher than expected. With inflation running roughly 3 times the Fed's 2% target, it's appropriate to be moving a little bit more quickly, Powell said in a discussion of the global economy at the meeting of the International Monetary Fund. 50 basis points will be on the table for the May meeting, and people, oh my god, the market's going to sell off, we're selling our stock. That's literally what happened today. So that news just came out. Stock market's down 2.2%. But the reason this doesn't make any freaking sense whatsoever, because people are like, oh, it's already priced into the market. Well, let's talk about the Canadian markets, because they already did a whopping 0.5% interest rate hike going into the beginning of March. And what happened? The stock market rallied in Canada. We went to all-time highs, for crying out loud. We jumped up 3-4%. And then all of a sudden in the last day, just like the US market, we're selling off. There is no correlation between interest rate hikes and currently what is happening here. I mean, if there was, wouldn't precious metals be flying right now? Isn't that the whole calamity with buying commodities and just being like, hey, gold, silver, inflation's going to go through the roof. These are going to be the easiest plays on the planet. I don't know what's going on. It doesn't make sense. You really think that the gold markets and silver would rally, but God knows, guys, they only just stopped printing money a month ago. So it's just like inflation's out of control. The money printer only just shut off. Why are things selling off so aggressively? You think people would still be looking for places to try and beat inflation? So somebody's sitting on a lot of cash, because it's not like the government's pulling it out of the market yet. So let's talk about it, because first and foremost, we are in a crazy consolidation period with the price to earnings of the S&P 500. You don't really see it looking at the general market or index funds like VOO or SPY, because they're so diversified. Some of those lower end companies that are rallying are basically keeping the market at a really good state. Why you should always be buying index funds realistically. But it's crazy, because if you take all the companies that have crashed, those high flying multiples have really brought us back down to getting close to a 20 PE. So it's going to be neat if we can actually hit that historical norm of being around a 15 to 20 PE. But it's quite a sign that we were in some form of a bubble. And this is clearly a bearish market deflating where the bubbly areas were, right? So let's talk about what wasn't exactly what I would call bubbly, but still getting absolutely crushed here. Because Facebook, guys, this thing just can't stop going down. I mean, you remember in March 2020 how giddy we were to buy all these companies because the Fed was printing money, everything seemed really good, you know, we're going to the pandemic, everyone's going to use social media, and it's just like we gave all of that up, we're back to these post-pandemic lows, and nobody really cares or wants to buy these stocks. And to put this in perspective, guys, I'm going to go over all the price to earnings multiples on these high-flying companies. So the PE ratio sits down here for the historical average, the price of the stock is up here, and then these are kind of the earnings right here, the net EPS, right? So this is the lowest price to earnings in Facebook's entire history of basically being a public company. That's crazy. It's insane. I mean, look at PayPal here, down 71% from its all-time highs. PayPal, historically the lowest PE it's ever seen, basically in this chart's history, going all the way back to 2016. Like I said, I'm not trying to point in a direction of buying or selling anything here. I just think these statistics are extremely unusually fascinating. So let's look at Netflix here, trading down massively, right? So if we take a look, this is also a historical low for Netflix's price to earnings that we haven't seen since 2012. 2012 here, guys. Shopify, another great example. Now, Shopify didn't start posting positive earnings except for up to the last couple years, because you can see they had no price to earnings up till coming into the pandemic. But even still, guys, this, from the time they started recording positive EPS, is the lowest price to earnings multiple. So let's talk about where I'm kind of concerned, because like I said, Apple, these mega cap companies are the only thing holding up the entire indexes from a tech weighted standpoint, and their multiples are still trading well above the S&P 500. So it's real skittish for me, because if we look at that price to earnings multiple, it is still trading at the higher end. So if there is even a hint of slowdown, and we're going to talk about how little of a hint it's going to take to crush Apple here, this price to earnings may come back to the historical mean here of being around like a 10 to 15. I mean, that seems kind of unlikely, but guys, I would have never expected PayPal or Facebook to be where they're at. So no cards are off the table here. Look about Microsoft as another great example here. Now, these companies have incredible pricing power. I think they're going to do okay for earnings, but it's just a matter of that slight miss. If things are just slightly out of pace. The risk tolerance for hedge funds right now seems to be like razor thin, right? So take a look at Microsoft because it's still trading at its historical highs here. I mean, Amazon, another one that I'm really worried about because it offered revenue guidance of around 3% for the first quarter. And somehow people haven't taken that as a bad sign, whereas they've taken it as a bad sign for every other company. Now, Amazon's a hard one to wrap your head around because historically they've always traded at a high multiple, and they've basically just been kind of increasing the bottom line slowly over time, bringing the EPS down to its lowest level. Basically, since it's been showing positive EPS numbers here. So it's hard to tell, but I still think Amazon is relatively overvalued. It's so hard to wrap your head around whether we're coming or going here. So Nvidia is one that I love. This is a company that I think is going to be a fascinating prospect into the future here. And I'm really going to be keeping an eye on this company when it comes to earnings because it is, well, even though the multiples pulled back, still historical highs, right? So these are some of the companies that are sitting in the S&P top 10 that trade at the current highest multiples against all the other companies that are out there, even compared to things like Google, right? So I don't know what to say other than if you are interested in buying the dips we're seeing today, I would preface maybe perhaps just waiting until after earnings to start picking things up, because even if things have great like gangbuster earnings like we saw with Tesla gave up all of those gains, guys, even though the earnings were so absurdly above expectations. So even the best of growth companies posting outlandishly good numbers can't rally in this market. So sitting on the sidelines I don't think is going to cost you anything, because even if Shopify doubles its revenue, EPS, whatever on this earnings, I guarantee the stock doesn't do anything. And I'm seeing this with even these foundational dividend stocks. I mean, look at Verizon, for example, here, guys. Verizon just posted earnings. And when I looked at the EPS initially, I was like, wow, these numbers are pretty good. They beat their EPS. Their revenue guidance only missed by, or the revenue missed by 0.16%. Literally, it's nominal. But just because they are seeing a bit of a slowdown, the wireless giant also amended its full year outlook Friday, saying that it is now expected to fall to the lower end of its previous issued guidance range on several metrics. I mean, for the first quarter, Verizon pointed at 4.7 billion, and they basically said, hey, we're seeing a slowdown now in user growth. Same thing we're hearing from all these other companies, and even Verizon gave up all of its gains, considering the value it already sits at, in my opinion, a PE of 9, great yield, and it's back down to where I started buying it at the beginning of this month. So that's a safe stock. This is the largest drop Verizon's seen since the pandemic, by the way. So, I mean, honestly, guys, if I were you right now and you're trying to play this, you're nuts. I wouldn't, unless you're a long-term thinker and you're just cost averaging into your favorite companies, usually the best way to do it. But honestly, because we don't know how low we could go here, I would really stick to index funds. In fact, like if the markets tank miserably, which I'm hoping happens with Apple, I'll probably pick up a little bit of Apple here or there. But I'm looking at the indexes here because if we see a full collapse in the S&P 500 or the VOO or the SPY, I'm definitely intrigued in buying the index, and I'm loving VYM here. VYM has been like the safe haven investment, I think, to avoid the volatility of this market, because you get such good energy and dividend exposure to companies like J&J Healthcare, the industries that have been actually outperforming in this market. I just think this would be a great place just to park that capital, sleep easier at night, and just see how things unfold here, because I can't be excited about any of this right now. I find it intriguing. There's a lot of stocks I want to buy. But guys, like it's like, do you want to get stuck in another BABA where you think you're buying the dip and then there's another dip and then there's the dippity dip and another dippity dip and you can't really keep coming up with enough capital to justify buying into them? So I mean, this is definitely an index fund. Just sit patiently here, guys, and just see how things unroll. Because, God, I would love to just see the markets normalize or even flatline, but we just can't find it. So I'm going to do a full portfolio review. I'll show you guys where I'm at tomorrow. If that's a conversation you appreciate, consider hitting that like button, subscribing for those future updates. And I want to know what you guys think about this market. What are you buying? How do you feel about going into tech earnings here? I'd love to hear about all of it. So stay cool, stay awesome. And as always, I look forward to catching you in the next one.